But is there any amount of vaccine optimism and recovery optimism that's going to lead you to revise your yield forecast higher?
Well, you want to think about it in a couple of ways. From a expectation of inflation, right? That would be a driver potentially of higher bond yields, and we don't really see that as a key driver. If you look at the building blocks of the measures of PCE, personal consumption expenditures, about 25% of that is coming from healthcare, whether that's healthcare services or pharmaceutical and medications, and the other probably 15 or 20% is coming from housing and housing-related aspects. We don't see a lot of inflation in those areas that would cause a major increase in bond yields. Our forecast from my colleagues in interest rate strategy looking around 1.3% 10-year U.S. Treasury yields by the end of 2021. It's a year from now. So that's sort of modest increase, but not dramatic. And really, as you know, we've talked before on this program, it's the pace, the speed by which interest rates back up that would be a concern. So there's a magnitude that's obviously of interest and important, but it's really how fast that occurs. And if interest rates kind of go up gradually, the equity market historically can absorb that.
Yeah, David, it's Morgan. It's good to see you. And just to dig into that a little bit more, I mean, you're talking about that inflation outlook from your perspective into next year. But nonetheless, with stocks near record highs right now, I mean, Fed liquidity has been a big part of the story. If we do see this economic recovery, vaccines begin to become much more mainstream next year, what does that mean for Fed and more broadly central bank policy and all this liquidity in the market, especially given the fact that you do have this 4,300 price target on S&P?
So the idea of the average inflation targeting framework that the Federal Reserve introduced would suggest that they're going to be on hold for at least the next several years, somewhere between 3 years and maybe as long as 5 years. Sort of depends. That's a long time out there. Let's just assume, Morgan, 3 years that you have the policy rate staying really unchanged. That is supportive of economic activity. I think that's the general thrust of the message from Jan and ourselves in terms of the equity market forecast is reasonably optimistic. And I think the way you attack this and the way you invest in it is sort of three ways. There's the cyclicals, not a surprise. They're the easy or near-term beneficiaries. David and others have talked about that. Then there's the value, and value is primarily in healthcare. They're the cheapest those stocks have been in 30 years. On a relative PE to the market, very attractively valued. And when you think about historically, they tend to underperform going into an election. Ultimately, the election in terms of Washington really hasn't been resolved, won't be resolved until the early part, January 5th, and the runoff in Georgia. And ultimately, we would expect there to be a rally in the healthcare sector. But ultimately, this low-rate environment is supportive of growth if you look out longer into 2021. So you think about kind of cyclicals, value, and growth. There are three trajectories or three ways to kind of embrace and invest in this market.
Shepard Smith here. Thanks for watching CNBC on YouTube.